Welcome again to the course Commercial Banking and Finance PFW 2401. This is Dr. Zabid bin Kamal. In this lecture, I am going to introduce you about the unit. I'm going to discuss the overview and the concept of the financial market and the financial institutions. I'm going to give you an idea about the learning objectives, the unit schedule, assessment structure, teaching teams, and other resources. So in 1929, there was a major recessions in US, which is popularly known as Great Depressions. At that time, people were withdrawing money from the banks, and this situation is known as bank runs. And so this actually led to bank failures, and as many as 3,000 banks failed at that time. So the bank failure actually lead to the economic failure, economic crisis. Actually, for these reasons, doing research in this area, these three gentlemen from the left to the right, Professor Bernanke, Professor Diamond, and the Professor Dybvig, they got Nobel Prize in 2022 for doing research on the banks and their roles during a financial crisis. So you can understand that banks are very important for the economy. And so this course is also very important for you because this course has important implications for your next courses, such as credit analysis, treasury management, and fintech. So if there is no banks in the economy, there would be only two agents. One is the user of funds, who is known as corporations. Another one is suppliers of funds, who is known as households. If there is no bank, so how they actually exchange money within themselves? For example, user of funds corporations, who are known as deficit units, and the supplier of funds households, who are known as surplus units. They actually buy different financial claims such as equity and debt from corporations. So what would happen if there is no banks? Savers or households face three problems. One is monitoring cost. They cannot monitor directly the corporations, whether the corporations are stealing their money or misusing their money or wasting their money. So there is an agency conflict. And what is an agency conflict? So here, if you deposit money in a bank is an agent. Okay, you are the principal. So yeah, for if the government is an agent and you are the principal, because you are letting the government to manage your assets, to manage your country. So there is monitoring cost, number one problem. The number two problem is liquidity crisis. Savers want their money when they need. But if you put your money in a corporations, you cannot want money whenever you demand. You'll not get it. So there is liquidity risk. And number three is price risk. Your prices of stocks and bonds may reduce. So there is a important risk if there is no banks, if people go to corporations directly. So banks solve these problems, these three problems. One is banks monitor the projects. Bank actually monitors the company. What the company is doing with the money of the people. Bank monitors it. And they can analyze the projects. They produce informations. They can employ analysts such as you who are graduating and working for banks. People do not have, households do not have that kind of expertise. The next thing is that banks provide liquidity by allowing withdrawals of funds anytime. So if you deposit money in a savings deposit or fixed deposit accounts, you can withdraw whenever you want. And so the third thing is that banks avoid price risk as deposits do not fall. So you are quite sure about or certain about your money if you keep deposit in a bank. So in one fine morning, you're not see that your deposit is gone. If there is no situation such as your fund is stolen by cyber criminals. That so there is a key role of financial institutions, for example, a bank. Number one is asset transformers. Number two is brokers. Number three is information producers. So if we look at the next graph, we can see that banks actually transform assets. How they do it? For example, bank buys equity and debt from the corporations, and then they sell deposit and different insurance policies to the households. In this way, bank actually converts or transforms the assets from equity to different deposit and insurance policies. Equity and debt is known as first primary securities, and the deposits and insurance policies are known as secondary securities. With respect to the function of brokers, actually banks facilitates transactions and produces informations. And the third thing is that banks produces informations. They actually analyze the projects, they analyze the economic situations, economic conditions, and they produce information for the clients. And what is a bank? Basically, a bank is a financial institution that buys money. That means it accepts deposits from the public and sells money by making loans. So bank means buying money and selling money. In the process, they make the profit, and the profit is known as interest. So banks have many more functions. For example, uh, they perform as a payment gateway. They allocate credits. Banks has the sole function of credit allocations in the economy. No one else do it. For example, an insurance company actually distributes the risk among many. A mutual fund basically diversify the risk. So bank's role is actually allocating the credit in the economy, and they are the only entity to and or licensed to do this function in the economy. So banks helps intergenerational fund transfer. Banks deals with maturity intermediation, for example, taking short-term deposit and lending for the long time. Bank monitors and provides liquidity, and most importantly, banks helps to transmit the monetary policy by the central bank. So there are many risks in a bank. Those are non-repayment of loans, fraud, cyber attacks, political unrest, theft, fund crisis, recessions, less demand. So these risks are losses, for example, credit, operational, fraud loss, shutdown, damages, for example, reputation, assets, people, etc., injury to their staffs and clients, danger, license cancellations. So there are many exposures of bank risk in newspapers, so you can find that. So these are uh, some of the examples of risk. So bank need to manage risk. How if they can measure it, they can manage it. And to manage the risk, bank need to identify the risk, assess the risk, monitors the risk, and risk reporting. And so they should have an institutional and structures with this risk identification to reporting process, and ultimately with board of directors and the related departments and the monitoring by the central banks. So why banks face some key risks? Number one, uh, asymmetric or incomplete informations. So asymmetric or incomplete information means some people have better information than you. Borrowers knows about the business better than the lenders. So actual lenders do not know how the borrower's company will perform. So and due to this, borrowers may fail in future, and so the non-repayment of funds will lead to credit risk. So moral hazard. So it is known as people intentionally will not pay. So they know they will not pay at the time of taking the loan. This will lead to moral hazard. Then it also creates credit risk. So then interest rate risk. Interest rate is determined by the central banks, and banks do not have any kind of control on setting the interest rates. So it is externally, exogenously determined by the central banks. So when the interest rate rises, of course, bank actually may lose or may win. So that creates interest rate risk for the banks. So banks often do not undertake deposits for 2 months and lends for 2 years. So this kind of asset liability maturity mismatch will lead to liquidity crisis or liquidity risk for banks. And different kind of frauds may lead to operational risk for banks. So what are the learning objectives of these course? We will see the bank's management from 4 dimensions. One is why and how banks are special. Number 2 is banks' performance. Number 3 is banks' regulations. And the number 4 is asset and liability management of financial institutions. So there are 7 learning objectives of the course. You can find it in the Moodle. And then this is an overview of Australian financial structure. So like financial structure of all countries around the world, financial institutions are divided into banking sector and non-bank financial institutions, whereas financial market are divided into money market, capital market, derivative market. So money market is for short-term fund, capital market is for long-term fund, and derivative market is for different kinds of derivative products such as options, futures, swaps, etc. So what are is the financial structure of Malaysia? And then you can see that, like Australia, so financial institutions are divided into banking sector and non-bank financial intermediaries. And there is financial markets, money markets, capital markets, derivative markets, offshore markets. So this is a basic snapshot of a financial statement. For example, balance sheet of a bank. So in the left side, you can find that liability sides, deposits, debt and equity. The right side, you can see that the asset sides, loans, investments, and properties. And then, so this is how the risk is inherent in a bank's structure. So if there is higher risk, it will eventually hit bank's capital, and that may lead to bankruptcy for banks. So this is the structure of our course. We actually divided these course in 12 weeks. And in first week, we'll focus on why and how banks are special. In the subsequent classes from class 2, week 2 to week 11, we will focus on different kinds of risk. And then in week 12, we'll focus on regulations of banks. So next we will be looking for unit schedule